Hi guys, this is Mr. Chake. In this morning's lesson, we're going to be dealing with financial indicators. And here they're saying that the following information was extracted from the accounting records of Mere Traders, a partnership between Mills and Langer. Their financial year ends on the last day of February each year. Calculate the following financial indicators for the year ended 29 February 2024. Number one, they want you to calculate your operating expenses on turnover for 2024. So what you do, you must remember the formula. Remember, the formula says it's going to be operating expenses divided by sales. The information will be contained in the income statement. So our operating expenses is 585,000. So it means you're going to say 585,000, and then you are going to divide by your sales, which in this case it's 3,459,000. So you say divide by 3,459,000, and then you multiply this by 100. Remember guys, you must make sure that you know the formulas. So 585,000 divided by 3,459,000 multiply by 100, it gives us 16.91%. So we'll have our answer as 16.91%. Then you move to the next one. The next one is acid test ratio. Now for acid test ratio, what you need to make sure that you must know how you are going to get it. So if you look at this, our acid test ratio, they didn't give us the total current asset. So it means that formula that says assets minus total current assets minus inventory will not work. So in this case, we just need to add trade receivables and cash and cash equivalent, which in this case is 223,100. So take 223,100 plus 100,000, and then we are going to compare it to current liabilities of 359,000. So those current liabilities will come here, 359,000. So maybe before you do anything, make sure that you get the total. So when you get the total, it's going to be 223,100 plus 100,000, which gives you 323,100. And then remember, this side is divided by 359,000. You also divide the side by 359,000. You divide by what is on your right hand side, and then remember your answer should be in a form of something is to 1. So we're going to say 323,100 divided by 359,000 is going to give us 0.9 is to 1. Then we have answered that question. And then next they are saying that you need to calculate the return on average equity and by the partners. So here what you need to do, I suggest that you calculate your equities separately, okay, on the somewhere on your answer book. So if you check our return, it's net profit for the year, which is 629,025. So it means you are going to say 629,025. We divide by 1/2 into, let's start with last year's equity. So last year's equity was as follows. It was what? So for 2023, it was 1,830,000 plus 140,000. Let's see how much you are going to get. So if you say 1,830,000 plus 140,000, it gives you 1,970,000. Then you write it there. So you say plus 1,970,000 plus the one for this year. So the one for this year is going to be 2,550,000 plus 120. Okay, now remember what is important here is that you need to make sure that your current accounts, you take into consideration whether they are debit of credit or credit. So in this case, all of them are credit. So we say 2,550,000 plus 120,000, which gives us 2,670,000. 70,000. Then when we have done this, we are going to put that 2,670,000 here. And then remember, this must be multiplied by 100. But in order to avoid you making any mistake, get the average of the two. If you say 1,970,000 plus 2,670,000 is going to be 4,640,000. And then if you take your answer and divide it by 2, it will give you 2,320,000. So 2,320,000 when you divide it by 629,025, and then you multiply by 100, it will give you the final answer. So 629,025, 629 and 25 divided by 2,320,000, and then you multiply this by 100, it gives you 27.11%. So guys, when it comes to your financial indicators, you need to make sure that you manage your time very well, because this is the question where you can get total if you want. Okay, now next they are saying explain whether the business is managing its operating activities efficiently. Quote two financial indicators with figures. So once they talk about operating efficiency, we are going to look at the profitability ratios, but we must not use markup. Okay, so if you look at this one, for example, we expect that our operating expenses on sales, it should decrease from 18% or remain the same. Okay, so remember we calculated it. So last year our operating expenses on turnover for this year is for 2024 is 16.91. Okay, so we have now 16.91. So you can see that it has decreased, right, from 18% to 16.91, and then operating profit on sales has increased from 19.5% to 22.2%. So it means that we are managing very well. So let's start with operating expenses. So I'm going to mention that ratio here. So I'm going to mention that operating expenses on sales. Remember, it must decrease this one. So it decreased from 18% to 16.91%. So it means that their expenses compared to from last year to this year have actually went down. And then you can just come here, look, last year our expenses amounted to 621,000, so they have decreased. So you can see it makes sense what we are saying. And then secondly, we are interested in the following financial indicator. Your operating profit on sales also tells us good news. Okay, so operating profit on sales increased from 19.5%. So we'll also say that. So operating profit on sales increased from I think so last year it was 19.5%. It increased from 19.5% to 22.2%. So it moved to 22.2%. So in doing this, you have answered the question. Now, Barry, explain how the business can improve their sales in the future. Code one financial indicator. So now, so in terms of improving their sales, you can see that their gross profit on cost of sales did not improve, right? So we can look at that. That's one formula that tells us about whether they are making profit, right? So we need to tell them that gross profit on cost of sales did not improve. So So we can say gross profit on cost of sales remained constant in this case, meaning that it remained the same at 60%. So what can they do? So here, what are they need? Okay, so here, what we've done here, remember, they said you should explain with figures, right? But you have already shown the financial indicator here, and then uh, you can also we've used the figure already here, right? So what we can say is that number one, I think here the person who structured this question, they were supposed to not show this part because it kind of makes learners to be confused. So we want to answer this question now. Here we have quoted the financial indicator, we've shown the figure. So what can they do to improve their gross profit? Number one, we can say they can avoid giving too much discounts, and then they can also do stock taking regularly to minimize theft. Remember, if people are stealing your stock, it means you're not going to have any stock to sell. Okay. And then next, they're saying the partners decided to increase their low their they decided to increase their business activities in 2024 and agreed to take up a loan. Explain how the decision affected the financial risk of the company. Code one financial indicator with figures. Okay. So now when we are looking at this, remember one of the ratios that talk about risk is debt equity, right? So we are going to say debt equity. We need to check what happened with our debt equity. Did it increase or decrease? So it increased from 0.3 to 1 to 0.7 is to 1. So we'll say debt equity increased from 0.3 is to 1 to 0.7 is to 1. So now we can see that the business is a high risk because remember 0.5 up to more than 0.5 going up is a high risk. So we can therefore say that the business is a high risk. Others will say that they are not credit worthy. Remember, when you look at this, almost 70% of what their debt is 70% of what they have in their own funds. So it means that they might have problems with paying in the future. And then next, they're saying provide two suggestions that the partners can consider instead of increasing the loan. So maybe they can, partners can contribute additional capital. Okay, maybe they can ask from their own families, for example, and then pay them late, and then but they don't have to go to the bank. Now there's other thing that they can do. They can sell unused fixed assets. If there are any fixed assets that they are not using, they can sell them so that they can generate money. Now next, they're saying should partners be satisfied with the return on their investment? Now what we need to do here, we need to tell them two things, but here they didn't give us the space for yes, but we will squeeze it on point one. We will say yes. So let's check. Their If you remember, their return is 27 point something. It was 27 point 11%. So we need to compare this to alternative investment. So interest on fixed deposit is 8.5%. So, and then also when you check, their return on partners equity increased from 22% to 27.11. Okay, so we're going to say that return on their investment increased from 22% to 27.11%. That's the first point. And then the second point will say that return is more than alternative investment by. So let's check 27.11%. 27.11% minus 8.5 is 18.61%. Okay, so what they're getting in their business is more than what they will get elsewhere. Now let's check the following. But a comment on the liquidity position of the business for 2024. Go to financial indicators with comparative figures. So in terms of liquidity, we need to know which financial indicators are we looking at. Okay, so look at their creditors payment period. Number one, they are paying early, very bad for them. Number two, debtors are taking too long to pay. Do you see? And then number two, stock turnover rate has decreased, so it means they are not able to sell as much as they used to sell last year. And then you can also check on your information. Let's look at their sales for last year was 3,450,000, but if you check, the increase is just 9,000. Okay, so we can look at that. So when you look at this, you can start by mentioning debtors collection, because their debtors are not paying within 30 days. And then you could also check the difference between their current ratios. But I don't like advising learners to comment on acid test. I'd suggest that start with the ones that are the easiest. Remember, they didn't specify which ratio do they want. So we can look at that has collection period. So it increased from 32 days to 56 days. Okay, so debtors collection increased from 32 days to 56 days, which should be very worrying for us. And then also creditors payment period decreased from, remember, creditors normally we're supposed to pay within 90 days, from 40 days to 35 days. To 35 days. Okay, so if you look at this, it says if we pay our creditors early, remember, it means we are not going to have money to do the things that we're supposed to do. Okay, now generally we can look at this to see on the liquidity that the business will have will have problems in settling short-term debts. So once you've answered like this, guys, you at least know that you got closer to the total or the total. Okay, Remember, I want to explain on this one of financial indicator. This one we have mentioned the figures, so they will award you a full mark for that. Okay, they didn't have to say explanation here. I think they were supposed to say suggestion, because they want you to explain how they can improve, but they didn't give you the space for that. Okay. So yeah, this is how you deal with financial indicators. I hope that this lesson has helped you guys. Thank you so much for watching. May God richly bless you. Shalom. And then also remember, if you want us to tell you, you can contact us on 073 036 3208. And then our lessons to prepare you for both paper 1 and paper 2 is just 500, where you will get 8 lessons, 4 lessons per paper. So please make sure that you use that opportunity. Thank you for watching. God bless you. Shalom.